with his perspective on the markets. Mayuresh, it's great to have you on the show. Our first key talking point is assessing value in PSU banks amidst all the turmoil that they're facing right now. Mr. Prem Vatsa has, of course, expressed his confidence if these banks were to be privatized, he would be very keen to, take them over. What's your own sense about, how clients are feeling about the whole PSU banking lot?
So, morning Tanveer, I think two aspects. One, clearly in terms of the core fundamentals for these banks and the regulatory changes that we are probably witnessing at this point of time in terms of asset resolutions. And the second element obviously becomes valuations. Now, on the first aspect of what we've probably seen over the last so many quarters in terms of first the IBC coming through, the next proposal which has just come through in terms of the AMC, a large element in terms of public sector banks still reeling under pressure, both in terms of recognition of asset quality on their balance sheet and at the same time I think almost a large element of the public sector banks coming under the PCA rules. So I think credit growth for these banks is going to be very, very difficult in a scenario where credit growth has actually started picking up. At the same time, I think the balance sheet expansion and the capital adequacy ratios probably not in the right element for a lot of these banks, specifically in the mid and small cap universe. So again, I think asset quality pressures can very well continue. The provisioning can continue. There is obviously provisioning related to NCLT. When you come to the second element of valuations, valuations are obviously very, very cheap. So on a price to book parameter, I think you take the biggest name right from SBI, right till the smallest bank. I think the valuations are extremely cheap compared to their private sector counterparts. But I think the inherent risk and the headwinds that the markets perceive that these banks can still go through over the next 2 to 3 quarters, to say the least, still leaves a bias towards the private sector banks. So that large retail private sector banks to the likes of HDFC, IndusInd Bank, Kotak Bank are growing their balance sheet very, very strongly. In fact, even on the asset quality side, a large part of their recognition, even in terms of the corporate retail lending banks, have probably improved. So the retail lending has improved, the corporate stress has largely got recognized. And though price to book might be a little bit expensive, I think the bias Tanveer still stays towards the private side at this point of time.
Okay, we'll let Dharmesh Kant go on that now. Dharmesh, thanks as always for taking the time out and joining in. What else is going to be in focus today is the entire agri theme, and just yesterday, we understand from our sources that the Prime Minister held a high-level meeting on MSP before the decision is taken up by the Cabinet today. The meet is coming in just ahead of the Cabinet discussion. Farm Ministry, Niti Aayog updated the Prime Minister on the procurement processes, and the PM was informed about the impact of the MSP hike. So on cabinet agenda today, they're looking at hiking MSP for key commodities, a 1.5 times hike in MSP or the minimum support price for agri commodities is what we understand is going to be taken up, and the government is very keen to announce MSP soon. So yes, it's an election year, and typically you would see such moves come in by the government. But in the listed world, Mayuresh, do you think this is going to be of a material impact?
Sorry, I didn't get a question, Aisha.
No, Mayuresh, just wanted your comments on the MSP meeting which is going to be taken up by the Cabinet today, and whether, investment-wise this is of a material significance.
So again, Aisha, I think a large element in terms of expectations of a large MSP hike probably something that the markets are gearing up for. At the same time, I think the concerns that are revving up in terms of if the hikes are substantially large, what kind of an impact will that have in terms of inflation, and at the same time in terms of controlling of the fiscal deficit. So I think those are two things that the Exchequer needs to probably balance or counterbalance as an argument's perspective. But a large element in terms of MSP hikes going through and the assumption that the monsoons are equally good this fiscal as predicted, I think the consumption spending patterns definitely improve. I think historically we've always seen that in a year where monsoons are better along with expectations of larger MSP hikes, the discretionary spending patterns obviously improve specifically in terms of the rural and the semi-urban economies. Having said that, the government spending program in terms of rural infrastructure and again I think rural consumption in respect of that is expected to grow multifold because that's going to get front-loaded as well. So yes, I think rural themes or rural discretionary spending patterns are going to determine a lot of volume growth in companies like FMCG, in consumer staples. You're probably going to see some amount of spike happening in autos. And even the extension, I think, paint companies, cement consumption will go up because pakka houses will, the kutch houses will start becoming more pakka in terms of cement outlook. You're probably looking at asbestos sheet players actually doing well. So there are a whole host of players that can actually do well, along with the usual plays of agrochemicals and then anything related to farm and farm equipment.
Mahesh, do you like the metals pack even now after the rally, or given what is expected of commodity prices in the near term, one would want to book profits here because they've had a fairly decent 2016-2017.
Oh, absolutely, Tanvir. I think it was a fabulous year for metal companies, both ferrous as well as non-ferrous in the year gone by. A large element in terms of trade wars and the implications thereof is driving LME prices lower. So in that sense, the expectations of dumping of a lot of Chinese stuff worldwide ex-US is probably causing that amount of pain. So from an immediate near-term perspective, yes, I think the kind of headwinds these metal companies might face can be very, very profound and very, very prominent as well. Having said that, I think the steel players which are domestically driven at this point of time still are in a very good position. I think the numbers through our channel checks still suggest that they're holding up in terms of expectations of volumes sustaining for these steel companies. A large element in terms of input costs that these companies had gone through obviously had an impact in terms of their EBITDA and their EBITDA per ton, which they reported in the last 2 quarters. But again, I think a large element in terms of what you're probably expected to see with input costs probably just stabilizing at this point of time and expectations of pass-through. The volume growth and realization growth should give leverage on their balance sheets. So an EV/EBITDA multiple, I think, though they're fairly valued from a near-term perspective, I think the demand outlook still looks extremely robust. So in that sense, I think JSW Steel, Tata Steel still becomes and hold for us. A contraband can be Steel Authority because a large part of their capex is behind them. What they've reported in terms of their bottom line losses that they've reported can easily reverse as the asset sweating starts happening and the leverage element gets played on their balance sheet. The number of semis on their product list is also reducing, so the products mix is improving, which can give an earnings upgrade as well. So sale can be a contraband with a long-term perspective.
Note from CLSA talking about their model portfolio coming in from Mahesh Nandurkar this morning, and they're advising raising weightage furthermore on IT as well as pharmaceuticals. They're removing Ramco Cements, Z as well as ICICI Bank from their portfolio, adding Maruti, adding Sun Pharma weightage in the portfolio now. Healthcare and real estate are their key overweights. Materials and telecoms remain their key underweights. But Mayuresh, do you believe there is merit in adding further weightage to IT as well as pharmaceuticals in your portfolio right now, given how swift the run-up has already been and the fact that it's only these 2 sectors which have performed year to date?
So again, I think the movement has been quite stupendous for both these sectors, but a large element in terms of where the markets find safety at this point of time probably remain these 2 sectors. The other element in terms of pharma specifically, I think a lot of concerns that were raised in terms of US FDA, in terms of pricing pressures, that has probably played out in terms of the earnings downgrades that you've probably seen, with a lot of resolution that has actually started coming through. And a lot of these companies, as I've been time and again repeating, have invested very, very heavily in terms of their R&D spends on creating a niche pipeline. So this niche specialty pipeline is something which is going to differentiate the larger pharma players from the smaller ones. So the niche players are obviously going to still have the earnings benefit over the next few quarters. Obviously the earnings trickle down in terms of upgrades will start happening from the second half, because the first half will still be a little bit patchy in terms of reported numbers as well as margins, which can still get squeezed because of pricing issues. But as these drugs start getting approvals over the next few quarters, I think the earnings should show a steady improvement. Sun Pharma, for example, had already indicated in their con call a double-digit revenue growth. The resolution of whatever has happened with that whole facility is obviously going to propel earnings growth. You're probably seeing other players, including Lupin, Cipla, actually having a very strong pipeline, or even to the likes of Aurobindo Pharma, which has a strong injectable pipeline. So I think select pharma names obviously look attractive from a long-term perspective. For IT in general, my own sense is that the kind of earnings growth that one really expects in dollar and constant currency terms will show a gradual improvement, because BFSI has been the laggard for the sector as a whole. As discretionary spending patterns start improving, BFSI will start contributing more meaningfully. The EBIT margins have stabilized, and so has the accretion levels. Utilization levels going up, the on-site offshore mix probably improving for these players. Though the element of wage hikes in Q1, Q2 cannot be ruled out, the second half, in my opinion, can be fully strong. So select players within the IT space, top tier ones, and even some niche mid-cap players probably look attractive. But the logic here has to be to buy them on a staggered way, because the run-up has been quite sharp.
Fair enough. It's just about 40 seconds to go before we hit the pre-open rates. Just want to quickly mark the top 5.
And whether there is merit in for investors to buy into Tata Global, given the kind of spots that one has seen on just the whiff of this news.
So again, I think this news is probably not confirmed at this point of time, but let's assume a few scenarios out here. For Tata Global in general, I think if you look at the core fundamentals, they're probably looking at expanding their non-black tea portfolio. So I think a clear indication is the different flavors that they're probably launching under the Tetley brand, specifically for its international operations. Now it's 2 JVs, one with Narishko specifically in terms of the rich vitaminized water. That is probably still a little bit shaky, but I think Starbucks is expected to probably have a break even on the console level by FY19. Having said that, again, I think the kind of revenue or top line growth that the street probably expects is anywhere between 8 to 10 odd %. So I think if you look at all their businesses together, I think with tea prices, coffee prices, probably adjusting to weather forecast and variance in that respect, a large element in terms of that revenue growth probably is expected to stay in that range of 8 to 10%. In terms of Tata Chemicals, I think the salt business with Tata Salt obviously has a 30% market share. What they've done probably in terms of the specialty and the consumer business is that for the overall top line for Tata Chemicals, it gives around 27% odd contribution. The other part of that element for Tata Chemicals specifically is soda ash and sodium bicarbonate. So let's not get into that aspect of their business. But the overall margins for Tata Chemicals on a consolidated basis have been holding up between 18 and 20 odd %. For Tata Global, between 11 and 12 odd % expected to improve, because the Russian and Chinese operations, which were margin dilutive, have probably got shut down, and they're probably looking at expanding their operations in markets like Singapore and Malaysia. So I think the revenue growth for Tata Global on one hand is at 8 and 10%. Tata Chemicals is growing at a reasonable clip because of its market share in both the soda ash business, the sodium bicarbonate business, as well as salt, acting as cash cows. So a large element of the salt business is probably taken out. Yes, in terms of what they probably had in terms of reported ROEs in the Tata Chemical balance sheet, that probably comes through in terms of Tata Global. But does that create a substantial impact in terms of earnings upgrades for Tata Global, where the own expectations on a standalone basis at this point of time stands anywhere between 11 and 12 odd rupees in terms of EPS? That can move up marginally. So again, I think the premise here is how the deal probably gets structured, if it does get structured. But I think the EPS upgrades will be, in my opinion, very, very marginal in terms of Tata Global's balance sheet if salt is added. So marginal upside to the stock from the current level.
Okay, here's another stock idea, and this time around from Abhimanyu Sofat of IIFL. He's betting big on Cyient on the